Elon Musk is about to run the biggest self-deal in corporate history. $3.4 trillion. Tesla on one side, SpaceX on the other, and the same man signing both sides of the paper. Here is the part that should bother you. If you own Tesla stock or a simple S&P 500 index fund, you are already in this trade. Nobody asked you. Nobody will. This is not a rumor anymore. 3 dates. January. Reuters reports merger talks between SpaceX, Tesla, and XAI. March. Tesla quietly converts its XAI investment into SpaceX shares, right before the IPO. July. On the earnings call, Musk hints at it again, in public, on the record. 3 moves in 7 months, all pointing in the same direction. So the real question is not whether something is coming. The real question is why. And the answer is not the one in the press releases. Here is my answer, and it is the thesis of this entire video. This merger is not about Mars. It is not about synergy. It is about control and about where the dollars sit. The mechanism is so simple you can do it on a napkin. Start with 2 numbers. Musk owns roughly 13% of Tesla. He has said publicly he wants 25%. Now look at SpaceX. He owns roughly 42% of it, and through supervoting shares, he controls close to 80% of the vote. Same man. 2 very different grips. And the 25% number is not new. In 2018, he tried to take Tesla private at $4.20 a share, tweeted, "Funding secured," and it cost him the chairmanship. In 2024, he posted that without roughly 25% voting control, he would be uncomfortable growing Tesla in AI. Read that again. The products change. The demand for control never has. So run the napkin math with me. Every dollar of value that moves from Tesla to SpaceX turns his claim on that dollar from 13 cents into 42 cents. That is more than a 3x on every single dollar that crosses the fence. Once you see that number, every headline about this deal reads differently. I call this equity gravity. Inside the Musk empire, value does not flow toward the best business. It flows toward the entity where his ownership is highest. That is the whole model. Hold that one rule in your head, and 10 years of confusing transactions suddenly make perfect sense. And there is a playbook for it. 5 moves. I'm going to fill in all 5 before we are done, because here's the thing. He has run this play before. Completely. Successfully. In public. 2016, SolarCity. A solar panel company run by Musk's cousins, and it was drowning in debt. Musk was chairman of Tesla. He was also chairman of SolarCity. He was the largest shareholder of both. Tesla bought SolarCity for $2.6 billion in stock, and Tesla shares dropped 10% in a single day. Move 1. A private problem grows somewhere in the family. Move 2. Point a public company's balance sheet at it. Move 3. Wrap the whole thing in a mission. In 2016, the mission was one integrated sustainable energy company. Today, the mission is Mars. The vocabulary changes. The direction of the money does not. Shareholders sued, and the case went to trial in Delaware. Years later, the court let him off. The deal was ugly. The process was worse, but it survived. And that is the real lesson Musk took home. Do not do this. The lesson was, this is survivable. Now here is the part almost everyone gets wrong, including, honestly, most of the coverage of this story. You think this video is a prediction. You think the self-deal is something that might happen someday, if a merger finally gets announced. Wrong. It already happened. This year. In March, Tesla's stake in XAI was converted into SpaceX shares, right before the IPO. Public company value moved one step closer to the entity he grips hardest. No shareholder vote, no lasting headline. That was move 4, and it ran quietly while everyone argued about whether move 5 would ever come. Keep count with me, because the count is the story. 2016, Tesla buys SolarCity. Self-deal number 1. 2025, XAI buys X. His own AI company buying his own social network. All stock. Same signature on both sides. Number 2. March 2026, the conversion. Number 3. The merger everyone is debating would be number 4. This is not an event. It is a machine. And it is running. So what happens to your shares if the full merger arrives? Finance already has a name for the destination. It is called a chaebol discount. In South Korea, the giant family-controlled groups, Samsung, Hyundai, trade at a persistent discount, 30, sometimes 50% below the value of their parts. Why? Because minority shareholders learn, deal by deal, that assets move between group companies for the family's reasons, not for theirs. Markets price betrayal. Slowly. But they do. A merged Tesla SpaceX, with one man holding a quarter of the equity and effective control of the vote, is a chaebol with a rocket division. And the discount does not arrive on announcement day. It seeps in quarter after quarter as the index funds holding your retirement money realize they are passengers. Now, the strongest argument on the other side, because there is one, and it deserves 30 seconds. Scale. SpaceX needs factories, and nobody on Earth builds factories like Tesla. Starship plus Optimus plus a million robots might genuinely work better as one company. And betting on Musk has made patient believers rich before. If you bought Tesla in 2013 and ignored every single governance scandal, you crushed the market. That is the honest bull case. But notice what that case asks of you. It asks you to price faith. And faith is exactly the thing a controlling shareholder never has to pay for. He gets your trust for free, or he takes the asset anyway. Betting on genius has worked. Betting on genius with your voting rights signed away is a different product entirely. So let us talk about who actually pays. If the merger prices SpaceX generously, and with Musk effectively picking the bankers at will, Tesla holders pay through dilution. Own an S&P 500 fund? Then you own Tesla, whether you ever chose it or not, which means a slice of your retirement account just became merger currency. The winners are whoever holds SpaceX paper before the ratio gets set. Employees with SpaceX equity, early insiders, and one person more than anyone else alive. That is the quiet genius of the whole machine. He never needs to take a single dollar out. He just needs to change where the dollars sit. So here is what I am watching. 3 signals. Signal 1, the vote structure. If Tesla's board announces a special committee, independent bankers, and a majority of minority vote where Musk's own shares do not count, then this thesis gets weaker, and honestly that outcome would be bullish. But if you get one bundled vote, take it or leave it. That is the SolarCity pattern, running again. Signal 2, the exchange ratio. Watch where SpaceX gets marked against its last private round. Every billion of generosity there is a billion of Tesla shareholder money crossing the fence. Signal 3, another quiet transfer before the deal. Optimus IP, Dojo Compute, energy assets, anything sliding from Tesla towards SpaceX while nobody votes. Each one of those is move 4, running again in daylight. And the lesson here is bigger than Musk. When you buy an index fund, you are not just buying America's profits. You are buying every controlling founder's incentives, at whatever price they set. The market's immune system for this was the Delaware court. He moved his companies to Texas. The referee did not quit. The referee got left behind. Which fills in the last line of our playbook. Move 5. The merger itself, wrapped in a mission statement, priced by friendly bankers, approved in a vote he cannot lose. None of this is financial advice. It is a map of the board, so that when the announcement finally drops, you have already read the play. If you want the update on the day any of those 3 signals fires, subscribe. That is the whole deal. Next video, the SpaceX IPO everyone celebrated, and the lockup math almost nobody read. Because the empire is not done rearranging itself, and your index fund is still sitting at the table.